you do see people out there that are into real estate, especially flippers, that are really into accessing hard money because they do not want to touch their personal funds. They don't want to touch their checking account. They would much rather go out, pay interest to someone else, essentially let them really take on a lot of risk. They know that there's even a small amount of margin. We're talking 6% in both of these scenarios. It's a 6% margin. One's a 66.67% rate of return. The other's 200. We saw in the TARP funds, it was only a 3.5% margin, and it was a 700% rate of return on their money. So it's really powerful when we start seeing that. And that is why real estate is so attractive to, I know, both of us here and to a lot of our clients that we help, get involved with it because of leverage.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Eddie Martini came on the show on April 13th, 2023. That's just recently here. That was episode number 778. What I'd suggest if you're listening to this episode is actually go back and check that one out first. You get to learn a lot about Eddie, what he does, and why he does it. We're going to have a little different flow here to the show today, where Eddie's actually going to more lead the show, and I'm kind of going to be here as a participant. And it's I think we've got a lot of good things here in store for you as well. The second thing I'd recommend is if you are listening to this, check out this episode in particular on YouTube, because we're going to be going through some spreadsheets. We're going to be doing some math. We're going to be doing some fun things here in the show that we don't normally do. And I think a visual version of this show would be particularly helpful for you. So check that out there on our YouTube channel, the How to Scale Commercial Real Estate YouTube channel, and you'll find this episode there as well. So those are the two things I would suggest. Eddie, welcome to the show. And if you don't mind, just take it from here. But first of all, if you can just give us kind of a rundown of the flow of what this show is going to be like here today, and then the floor is yours.
That sounds great, Sam. Thanks again for having me back. I really appreciate the opportunity. And I thought today would be really good to actually break down the power of leverage and OPM, which stands for other people's money. I mean, you and I both already have an attraction to it. We know kind of how it works, but I feel like a lot of people we come into contact with that want to get into real estate investing, they really don't understand the basics. So if you're good, I'd like to share just some financial calculators with you. We'll kind of, again, show the math behind how banks do generate money, how they generate the rate of returns, why they have the biggest buildings in the most prime areas across our country. It's because they can afford to, and they make some really great rates of return. So we'll share that with everybody. And then if you're open to it, I figured we can underwrite a recent transaction that a client called me on, really see how people like you and I dive into the numbers to really make sure it's something that's viable and worth pursuing.
That sounds like a plan, Eddie. Let's take it away. How do banks indeed then make money?
Fantastic. So we'll start here. We'll take a trip back in time, Sam. We're actually going to head back into the 1980s. And believe it or not, back then, banks were actually paying 9% on CDs. And a lot of my clients are like, what? Take me back to the good old days. 9%, that's better than my retirement account's doing. And I'm like, absolutely. But with the good came the bad. And on average, they were charging around 15% to lend money to people. So before I really understood the truth behind the numbers, I kind of looked at this and in plain sight, we're like, great, we have a 6% margin. They're making 6% on their money. But when we actually dive deeper and see what that looks like year over year for them, just creating that small margin, it's actually a 66.67% rate of return. Can you believe that?
So break that down for me. I might be not had enough coffee yet this morning. How is that possible?
Yeah, you bet. So this right here, this is how we are showing proof of actual leverage and utilizing other people's money. They're taking money in, even though they're paying 9% out. For every dollar that you are paying 9% out, you're actually able to lend out at 15. So when they break that down, that actually generates not just a 6% margin, that is actually showing that is a 66.67% increase in the dollar's value.
Right.
So it's just phenomenal when you start seeing that. And so I looked at that, and I think you and I both get this a lot on what's the purpose of OPM? Why do we look for other people's money? Why are we paying someone else interest when we could just utilize our own dollars? And so I wanted to break that down real quick. And again, we're back in time, we're in the 1980s, and let's say I went to the bank and I borrowed $100 from them. Well, they're lending money out at 15%. So at the end of the year, I would owe them $115. This one's a little bit simpler when it comes to the math, because that comes out to 15% rate of return.
Sure.
Right? So they're utilizing their own dollars in this scenario here. They're only making 15%, but up here, they're able to leverage and borrow essentially other people's money and utilize that to actually lend now to others and make that small margin.
Sure.
So it became super powerful for me. And if we even take a step further into time and we head into the 90s, we had that whole savings and loan fiasco going on. And even with the banks making 66.67% rate of return, they still got themselves into a pickle. And good old Alan Greenspan, he was the head of the Federal Reserve at the time, and he started looking at the bank's books, and he's like, "Wait a second here, guys, you're paying 9% on CDs? Are you kidding me? Because those are guaranteed rates of return. This isn't supposed to be a retirement account. This is something that's supposed to be a safe place for people to just save some dollars." So he said, "This is absolutely ridiculous. You guys really should only be paying 3% on CDs." The bank said, "Okay, that's fine. We'll do our 3%, but we still want to have that 6% margin." So bank rates were around 9% on average then. So when we look at that math and see what they're able to do on that spread, 200% rate of return. And it's just amazing to me. Everyone thought Alan Greenspan had some magic fairy dust. No, he understood the math behind the scene. He understood that, you guys, if we can get our rates of return at 200%, you guys are going to climb out of this hole rather quickly. And they did. Within months. They got themselves out of that savings and loan fiasco. So it's really powerful when we start seeing this and we take another further step into time. And a lot of people don't realize that during 2008, during the unfortunate mortgage crisis and resulting real estate market crash, the government looked around and said, "Wait a second, all these foreclosures that are still coming to market, if we start seeing all of that continue to happen, there's not even going to be dominoes to continue to fall. Our economy could just be gone, poof. So we need to step in here and see what we can do." So they came up with an emergency program called TARP, and they started releasing funds to the banks, and it was billions of dollars that they were able to lend out to them. And I saw it at certain points, it was down to 0%. That actually carried for a very long time, 0% dollars to the banks. At certain points, it was 0.25%. And the highest I saw TARP funds being available was 0.5 point. So we're just going to give the banks a worst case scenario of, hey, you guys, caution you guys 0.5% in order to access these funds. They looked around, and yes, they had some derivatives they had to pay off on those bad mortgages and kind of get their books balanced a little bit better. But by the time they got all of that figured out, they realized, well, we actually still have cash reserves on hand, and we actually have more TARP funds available. So they said, let's see here, what can we do? Oh, you know what? Right now, treasuries are actually paying 4%. It's a guaranteed rate of return. And there is nothing that's forbidden us to hop into a treasury. So let's see what that does for them. 700% rate of return. Sam, even worse, as far as my opinion, even worse, they're utilizing taxpayer dollars in this scenario to access the funds. They're using taxpayer dollars to pay back the rate of return. Pretty darn brilliant, don't you think?
It's absolutely brilliant. Yeah, you look at it from this perspective, like, this is crazy. Like, we have a government created entity that's lending money at 0.5% to turn around and buy government backed treasuries that they're going to get 4% on. It's just a convoluted cluster, if you ask me.
I couldn't agree more. And the feds did finally catch on to what was going on. It was, of course, down the road after these rates of return were still going bananas, and the treasuries were dropped down accordingly. But we still look at this and we go, well, 300% rate of return, that's still not a bad day for those banks. Why in the world would they ever get back into banking when you start looking at this? It's like,
Right.
well, let's just keep accessing TARP funds, right? And we'll just keep recycling this. Well, the challenge with that, Sam, is that this can only be done once a year. It's a 1-year commitment to get that rate of return from the treasury. Whereas if we step back in here to the 90s, this is our fractional reserve banking system. So for every $10 that gets deposited, they can go lend out 9 of those and just keep the $1 in reserve. So they can do this over and over and over again, which is why they did, of course, get back into their day-to-day of being bankers.
Right.
But,
Right.
right.
That makes perfect sense. You borrow at 3, you can lend at 9. You're 200% rate of return. It's a great model.
Indeed. So when we really look at this, and like, the banks are the OGs of OPM.
For sure.
right? I mean, they figured this game out a long time ago, and the rest of us, which is smart of us, we're looking to duplicate success. There's no point in reinventing the wheel. And so this is why you do see people out there that are into real estate, especially flippers, that are really into accessing hard money because they do not want to touch their personal funds. They don't want to touch their checking account. They would much rather go out, pay interest to someone else, essentially let them really take on a lot of risk. They know that there's even a small amount of margin. We're talking 6% in both of these scenarios. It's a 6% margin. One's a 66.67% rate of return. The other's 200. We saw in the TARP funds, it was only a 3.5% margin, and it was a 700% rate of return on their money. So it's really powerful when we start seeing that. And that is why real estate is so attractive to, I know, both of us here and to a lot of our clients that we help, get involved with it because of leverage.
Right. Right. And that cuts both ways. I mean, because we do that again, when we go out and buy a property with leverage, we're doing the same thing. It's just the numbers are changing. Maybe let's say in this case, I'm borrowing at 9 and I'm returning at 18%. Now my spread is, I'm getting a 200% rate of return on my money, or I guess 100% rate of return on my money.
Yeah, you're doing great. Yeah, let's see this. Yeah, if you do 9 and 18, boom.
That's 100% rate.
It's 100% rate of return.
Right.
So it's super powerful when you start looking at it. And so if you'd like, we can kind of hop into an underwriting transaction now and really see, kind of how this works.
Yeah, we can. Let's do that. And I may not have had enough coffee here this morning, but it's just the same. I think I already said that. It's the same thing, just repeated. Like we borrow because leverage is beneficial. It juices our returns. And that's the same thing for the bank. They borrow my money to then lend out to somebody else, and it juices their returns. So yeah, I guess there's always the debtor and the lender. Somebody else's debt is somebody else's equity, and it just seems to keep repeating itself. So I think at some point in this show, you're going to give us how we get out of that cycle. I know that is part of the equation here today. But let's do an underwriting. Let's see what that looks like on a deal maybe that you've done recently.
Absolutely, that sounds great. So yeah, we'll hop into, and this is what's great, Sam, is you and I both know that to get into real estate, the first thing you need to learn how to do is how to underwrite a transaction.
Yeah.
Right. We have to see, is this a viable option or not? Because I mean, that's really what I think causes a lot of failure in this industry, is people getting a little bit too far ahead of themselves. They get too deep into a transaction without doing their due diligence. And this is the very first step I think any of us should take if we're considering investing in real estate. So we'll look at a recent transaction. This is based in the California area. It's a really cool industrial building. It actually happened to already have two great long-term tenants in it. So it was a really clean deal, and I think it's a great one for us to kind of go on display here. And so we'll hop in here, and the first thing we want to start with, of course, is our purchase price. What were we looking to purchase? And these fields can be different. So that's why I had to type that in actually twice, is because we have been in markets, you and I both have been through them, where property values can either be higher or sometimes lower than what the actual purchase price is going to be coming in at. So it's important to be able to have that flexibility.
Right. So in this case, if you're just listening to this, Eddie's putting in $650,000 in both the value and the price of the property.
That's correct. Very good. I appreciate that. And closing cost wise is going to be the next field we're going to input here. And this was a buyer transaction. So typically, really across the nation that I've seen, it's very typical for sellers to cover for the majority of the closing costs. This client in particular just had around 1%. So $6,500 was going to be their closing cost fee here. And that was really just going towards some miscellaneous title and escrow fees and a few inspections. So nothing too major there. Sure. Again, realtor fees, we can plug them in. It is an important field to be able to have access to. In this instance, though, this was a buyer that I was looking to conduct this analysis for. So there's going to be 0% in realtor fees. The next important thing that we need to understand, is why we're going to get a cost value approach when it comes to our appraisal, is we want to determine what the difference is between land value and our structure value. And you and I both know, Sam, the reason why that's so important is because we can only depreciate the structure value on these properties. So this instance, it came out to around $100,000 was going to be our land value. That left $550,000 for them to depreciate. And since this is a commercial transaction, we get 39 years to spread that over. So it's this, I hope you guys are starting to see why Sam and I really like real estate as part of our retirement and our investment tools, because of this leverage, because of depreciation. The tax advantages are just really almost unmatched. So we also have the ability, after we get the land value and structure value calculated, we're able to see that you can see my basis for depreciation did not auto-populate. Again, this is because sometimes, Sam, you and I have people that come to us that already own a property. And so they've already done some depreciation. So we need to have that field as being flexible. In this instance, it was a brand new purchase. So the basis for depreciation is also going to be $550,000. We did find a first mortgage that was able to go ahead and pick up the transaction here, which again, that's why it's so important for us to have, the right network put together as far as trusted advisors, because not all advisors are created equal. And having a trusted lender advisor is super crucial. In this instance, our lender advisor was able to find someone who was able to carry 80% loan to value in a first mortgage. They did not charge any extra points, and they were going to charge them a 6.99% rate. Fair, all in all, in my opinion. Since it was a commercial transaction, they're going to spread these out over 2 years, which would be a loan term of 240 months.
I think you meant 20 years there, Eddie.
Oh, thank you, sir. I appreciate that. Loan term of 20 years spread over 240 months.
Right.
So that's going to calculate a loan payment of $4,028 per month is what that's going to come out to for overhead on this transaction. In our first analysis here, there's not going to be a second mortgage. This particular buyer did have the ability in their checking account to go ahead and come for this total down payment, which again is going to be $136,500 for this initial analysis. And property taxes came out to about $677.19 per month. His insurance was going to be around $450, and the maintenance was really light. Like I said, it was an industrial warehouse space, all pretty much paved, very little landscaping. So quick mow and blow, nothing major there. But you can see, Sam, we can get quite detailed as needed. Right. People looking to purchase condos, townhomes. We can plug in the homeowner association fees here to really get deep into this. If there are any miscellaneous fees, we can go ahead and plug them in here and make sure that we actually understand really from a macroeconomic approach what we're looking at. Mm-hmm. We did have tenants already in place, which again is super magical. Not always going to be the case, but in this instance it was. They're paying around $7,000 per month. And the next important thing, Sam, you and I both know this, that's super important, is that we need to understand what are the costs of being an investor. And at the end of the day, there are going to be taxes implicated. Now, I know you're screaming, going, Eddie, what about 1031 exchange? I get it. We will go there, Sam. We will get that calculated in a second. But I always like to conduct analysis in a worst case scenario situation. How can this transaction stand on its own 2 feet? If we can make it better with these other tools, great. But let's really see where we're at. So this particular buyer was in a 25% income tax bracket. We'll all be in a 15% capital gains bracket. And since depreciation recapture tax is a sliding scale, and it goes up to 25%, and it really depends on what your actual personal income tax bracket is, he would have been subject to the maximum of 25% in depreciation recapture tax. And so we also have the opportunity, Sam, for people like you and I who are real estate professionals, we can go ahead and check a couple of these other boxes. Or again, if someone's just looking to see, hey, what is my primary residence I'm looking to buy? What does that look like rate of return wise? We can plug that in. We can get some extra tax advantages that auto calculate over here. So when we take a look at, what this transaction is able to do, we want to see how long are we holding this for? And he said, okay, Eddie, I really only want to hold it for about 5 years. I'd like to see at least what that looks like. If it still pencils out after that, great. But I really want to take a look what that is. And Sam, he was looking to hit 10%. That was his goal. And if we look right here, even, one thing we need to factor in, right? We want a worst case scenario. Let's factor in 6% in closing costs. Okay. Again, you and I both know it's a negotiable fee, but we want to hit them with worst case scenario.
And we're assuming where you are right now is on disposition of this property in 5 years?
That is correct. Thank you for clarifying that. So this now is getting kind of the end of the road. We've now plugged in for as far as the analysis goes. We want to see if I hold this property for 60 months, also known as 5 years, what does it actually look like for me? And really, it was healthy. I mean, 12.52% rate of return And that is without factoring in any appreciation. So again, on its own 2 feet, I think it's really a fantastic opportunity. But Sam, you and I both know it's also why we love real estate. It has a extensive track record of having positive appreciation. I think 4% is actually pretty conservative at the end of the day. But again, we can always play with this if someone wants to be even more conservative that, or if they want to be more aggressive, we can really see what things look like. We plug in 4% in appreciation over those 5 years. We just went from 12.52 to 21.77% rate of return. This buyer was ecstatic. He couldn't believe what he had kind of stumbled onto here. And so it was really powerful for him to be able to go in, not really have to be too aggressive on his negotiations. He knew it already penciled out to, what he was able to do. And it made for, a really successful analysis conversation with he and I. Now, again, we want to see, Sam, what does it look like with the 1031 exchange, right? If we don't have any tax consequence, if we're basically going to forward all of those onto a future property, look at that. We can break 27% rate of return on this transaction if he does not have to, if he's going to exercise a 1031 exchange. So we can conduct these, again, rather quickly with people, give them a really nice snapshot of where they stand and, make sure that something's viable. But as you mentioned earlier, in our conversation, I help people make this even better. And that's what I really love about creating strategic savings accounts is that we can take an awesome investment opportunity like this real estate transaction and we can 4 to 5x the rate of return. Would you like to see how that works?
Yeah, let's dig in.
All right, my man. So we wanted to factor in that this gentleman had worked with me in the past and he had built what's called a wealth maximization account. It's basically a strategic savings account that allows our funds to grow at 50 to 80x the rate of return that you'd get at a commercial bank. It allows us to still maintain the access, the liquidity that we need to be able to invest in opportunities like this when they come. So I'll just point out some really important factors to why a wealth maximization account is better than just relying upon another source of OPM, such as like hard money. So in this instance, he did have access to 130,000 in his wealth maximization account that he could put into this transaction. What's really important, again, to understand is your first lender that's putting this 80% up, if this wealth maximization account was actually a true loan where there were strict repayment scheduled payments coming into play, we'd have to report that to the first mortgage. We'd have to tell them that, hey, there is actually a second lien being put in place on this transaction. And so in this instance, that would be going back to the first mortgage and saying, hey, surprise, we're at a CLTV, a combined loan to value of 100%. Do you still want to give me the money? Their answer would have been no.
Right.
So this is really powerful in that you've built your own private family banking system. You're able to access those funds just as you would with getting a hard money second. I think it's also being a good steward. We'd want to see what would a hard money lender charge me for a lien being in second position. We actually did find one. They weren't that unreasonable. It was actually really cool to see that there was money out there available at 9.98%. And so I just told the client, you actually get to decide what you're going to pay yourself back. But I just think being a good steward of our money, we should pay ourselves back what someone else would have charged us. So he agreed to that. He at least wanted to see what it looks like, in this analysis to see, okay, does that actually still pencil out? I said, let's check it out. We're also going to amortize this over the same time period we would the first mortgage. They're basically being paid down at the same rate. So we're going to do a loan term of 240 months, which again is 20 years. So yes, this is going to affect our cash flow. We are now looking at 52.81 per month just for our mortgage payments, where before we were at 4,028. So that did affect our cash flow. But Sam, if you look at our rate of return, we just jumped to 91.84% rate of return from 21. So that is largely due to the down payment right here, only now needing to be $6,500 is the actual cash out of pocket for this buyer. And he was able to turn $6,500 into a net cash out of $141,672 over these 5 years.
That largely stems what you're calling a wealth maximization. Do we call it wealth maximization?
Yeah, wealth maximization account.
There you go. See, I told you,
Yep.
not enough coffee here today. I can't even speak. I'm on a podcast all day long. So I'm guessing this wealth maximization account is just another name for a whole life insurance policy. That sound about
Yes,
right?
that is. Yeah, that's correct. So instead of the traditional way of doing whole life insurance, where in my opinion, you might as well go dig a hole in your backyard, put 30 grand in it, and then 20 years go dig that hole back up and pull your 30 grand back out. That's about as efficient as most whole life insurance policies are, traditionally speaking. But modern whole life insurance that's a cash value focused purpose, it turns into a very, very powerful financial tool, as we can see right here.
It does, and the reality of it is that 130,000 is still your $130,000. You've just put it in a different account, right?
That's correct. That is
Right.
exactly correct. And that's the big key. Whereas, we get our money locked up a lot of times into, qualified retirement plans where we don't maintain that access, that liquidity. Now we have the opportunity or the option of missing out on these opportunities of a lifetime, just like this gentleman found. He was able to pick up the phone, get a wire, 130 grand sent over, and consummate this deal with a big smile on his face, knowing what the future looks like.
Sure. Yeah. I mean, your rate of return, and I might be contrarian here on this podcast, but I think it'll shed some light. Maybe you can tell me why I'm wrong. But the rate of return has gone up so much just because as we're modeling it, it's just showing basically all but $6,500 in leverage. So, I mean, obviously, the higher the leverage, the greater your rate of return would be.
Absolutely. You got it, Sam. That is exactly what we're trying to get at with people. And also, again, he had the money. He had 130 available in a checking account still. But what he can do now, Sam, is technically, if he can qualify for more mortgages, he can go basically 10x this now. So that 130 grand, he can spread it out if he only needed 25 or $6,500 increments of it. I mean, he's got a long ways that money can now stretch where he can go repeat this process. And that's what I think is really, really powerful about having other sources of OPM.
For sure, for sure. And I know some very smart people in the real estate world that are big proponents of this model. So it's when you hear me give contrarian views, I think it's because I wanna really just clarify some things on this. So the questions I would have would be like, okay, so you got cool. We did this in a cash value whole life policy. We've paid into it over all these years, and now we're going to pay that policy back a 9.98% rate of return. At what point in time do I, as the investor in my own private bank, get to then have access to the fruit of paying myself 9.98%? How do I get that back without taking a loan out of that policy and then owe it back to the insurance company? Does that make sense?
Yeah, no, I can follow what you're doing there. Yeah, I mean, essentially, this rate of return, it's kind of a moot point as far as how you're paying it back. You're not able to inflate the rate of return that your policy is actually going to get. So even if, let's just say, the cost of these funds were even 1% or even 2%, let's say it actually costs you money to borrow your funds back.
Right.
If you're paying yourself back at 9.98%, you're just accelerating the amount of principal that will now be available for future transactions. So it's actually a really cool process because once you actually get to years 10 and beyond, there actually is no cost to take these loans out. So you're credited to the account exactly what the cost is for the loan. So you're at a zero cost from years 10 and beyond to repeat this process here, where that, again, in that scenario, that 9.98%, I mean, that's going to rapidly accelerate how much equity essentially you're establishing back in your cash value of your policy. And what's really powerful, the reason why you do not have a repayment structure is that those policy loans are backed by a life insurance policy. So the life insurance company understands that, heaven forbid something happens to you, they can deduct whatever outstanding loan balances are from your death benefit.
Right.
So it makes it a real big win. And that's why I like storing my cash with these type of companies, is that they are extremely conservative with how they generate their rates of return. And so I'm not looking for them to hit any big home runs. I want a nice, safe place. I want contractual guaranteed rates of return. I do want the ability of participating in margins. I do like that part of it. But I don't want that to be based upon why I'm doing this. This decision is purely made on if I could save at XYZ Bank at 0.015%, or I can save in my family bank at 4 to 5%. Where would I put my money?
Well, sure. I mean, in that scenario, that makes sense. But I guess going back to, we're growing this principal, right? We're growing this principal balance, but to what end, other than just growing that principal balance? At what point in time can you go to that Sam's Personal Bank and say, all right, cool, I want to go buy a, I don't know, let's make something stupid up. I want to go buy $1 million airplane and I want to go fly it around the country. And how do I get that money out of Sam's Personal Bank to buy my airplane I want to fly around the country?
You bet. I love it. So yeah, the great news, Sam, is actually year one, the very first year you establish this, you already have access to cash value. So there's not really a vetting period as far as, hey, once you hit this year, now you can access this. You have access to it from year one.
Right.
So in that scenario, yes, you had the ability, you've stored up enough cash value to purchase, your private jet. It is as simple as there is zero underwriting involved. That's what else, Sam, I really enjoyed about this is before, when I was so real estate focused and building equity focused on my real estate, there were times in my life where I could not qualify to access the amount of money I needed to purchase more transactions. I couldn't document enough income for the underwriter to say, yes, I'll give you another loan.
Right.
Well, in this instance, my money's not locked up. It's still a phone call away. I do still need to make a phone call, but it is, where do you want the money sent? Not, what are you using this for? So that's really powerful. I mean, you and I both know, Sam, there's times where we need to invest in ourselves. We need to be able to join some mastermind groups, develop some skill sets, whatever it may be, to actually sharpen our saw so we can be successful in the investments we're looking to pursue. Well, it takes means to be able to participate in those kind of things. So I've utilized my funds for those exact reasons. Like, I'm actually flying out to Houston at the end of the month to further dive into this Truth Concepts training. And those are funds I'm going to access from my family bank to, again, reinvest in myself, so I can add more value, not only to my own investment pursuit, but as well as to my clients.
That loan that you take out from that policy to do what it is that you're talking about is just that, though. It's a loan, right? You now owe that back to the insurance company.
Yes, sir. That is correct.
Okay.
That is
there
correct.
Ever a point in time in which you can harvest that equity that you have built without then owing it back to the insurance company?
It's a great question. Yes. So similar to your qualified plans, any funds that you've actually contributed towards it, because these are all post-tax dollars that are being contributed to these funds, you have access to all of those funds, zero cost, no loan needed. You can liquidate. There's no penalty behind that. The only time you're going to see a tax consequence in these is if you go to liquidate above and beyond principal that you've put in, and now you're tapping into the gains that have been earned in this. If you do not want to take a policy loan for whatever reason, if you actually do the math on it, and for a reason you decide that it makes more sense to liquidate it and take the tax consequence, you do have that ability, but you would only have a tax consequence if you tap into liquidation of gains.
Got it. Okay. So again, going back to that 9.98%, that is gains. And you start liquidating those gains, then you start getting taxed on it. Is that correct?
Yeah, it's actually more so the policy itself that's generating the 4 to 5% internal rate of return. Those are more so the gains that I'm referring to. Because again, I wish the policies would allow, like you said, to say, hey, I've got an investment opportunity that it pencils out and I can pump 9.98% now into this cash value focused life insurance policy. Unfortunately, it does not work that way. You cannot backfill gains. It's going to be, the gains are earned on you contributing monies towards premium. And the way I set it up, most insurance agents do not like me because I build these things where they are cash value focused. And so that means that there is the least amount going towards actual principal base premium, and there is the most amount going towards cash value. So that's what turns these around into, again, from a typical and traditional whole life insurance policy, that again, with that whole digging a hole in your backyard scenario, versus a modern cash value focused whole life insurance policy that turns this thing into a supercharged savings account, which happens to come with a life insurance policy.
Right. All right. I got one more thing to throw at you. That has been kind of maybe a hiccup or something. Maybe you can explain here in our analysis and tell me what I'm missing. With say Bank A, right? You go to Bank A, you put $100 in Bank A. I can go to Bank A tomorrow and I can withdraw $100. I go to a whole life, or in this case, the wealth maximization account, and I put $100 in, the cash value might be, I don't know, especially early on, $30, $40, something pretty low. So we're not taking into account like the amount of time it takes to break even on that policy before it's like, okay, I've contributed. And again, I'm just using that number. I wish my $1 million would buy a jet. That would be fantastic. I'm not sure I want to fly in a $1 million jet. That sounds sketchy to me. But either way, it's going to take me a certain number of years before my cash value and actually deposited funds equal or kind of become the same. Is that correct?
That is correct. So that's a great point you did there, Sam, and I appreciate you bringing that up. So there's going to be a certain time, I guess you'd call it a vesting period, vetting period, however you want to put a label on it. But yes, how these policies work is the insurance companies do have to make money, right? If they don't make money, they go out of business. And then this whole family banking concept, which is really cool of them to do, they give us everything we need to have a bank without the brick and mortar, and we can all access it. It's really neat, but they have to be able to stay profitable. So yes, those first couple of years, there's going to be premiums paid that, and some of those dollars are going to go towards paying commissions. They're going to go towards their just administrative costs, and just again to make sure they stay profitable. Because guess what? At the end of the day, it is a life insurance product. So heaven forbid something happens to you in year 1 through 5, or even 1 through 7. But let's say you've only contributed $100,000 by year 7. Well, your death benefit is probably going to be $700,000 to $800,000 that they're paying out to you. So when you start doing the math on that, as far as rate of return, you're still into the 50, 60, 80% rate of return, which again, it's not supposed to be considered an investment. But if we're actually looking at the numbers, that's how that works. I would say typically, Sam, years 6 or 7 is when we're actually at a break-even point, if not positive in the amount we've contributed versus the amount we have access to.
Right, and that is just, I guess, a part of the equation that you have to build in there. Again, there's some really smart people that I know and respect that use this strategy quite a bit. I'm still warming up to the idea. It's something. It's just personally, it's like, okay, I got to figure out how this all plays in. And I think this has been very, very helpful. So when you hear me throwing things out there that are clarifications on it, that's just it. It's like, okay, how do you make this work? And again, I know there's 1,000 ways to structure these, and like you said, there may be traditional methods of whole life policies where we might as well just stuff the trash bag full of money and lit it on fire and called it a good time. So I know there's ways to do this. I just want to get some clarification on that, and thank you for pointing that out. Year 6 to 7 is about when the dollar amounts are the same. So all things being equal, you probably just had to calculate in on the, somehow the time value of money over that period to make it just slightly more clear as to what it is you're doing. But again, I know there's some advanced strategies here we're talking about and ways of making this work. So I'm not saying you're incorrect by any stretch, just getting my head wrapped around it. Anything else you want to clarify on that front, maybe that I've missed there, Eddie?
No, you actually, Sam, I appreciate and I really welcome those challenges, because that's how people, I mean, there's a lot of people that are listening and watching this right now. They're going to have similar questions. And so I don't want them getting hung up on, hey, my grandpa always told me that life insurance is expensive and not to pursue it. I get it. I'm not saying your grandpa's wrong, because the way he understood it, the way he was presented life insurance, it probably was not as valuable of a financial tool.
Right.
But there are strategies out there that with some really simple changes and some simple riders that you can add, you can make these really powerful financial tools. And it was hard for me too, Sam, to wrap my head around initially. I'm like, wait a second, if I've got 100 grand right now, why would I only want to have access to 92 of it, at the end of the year,
right
at the end of year 1? Well, right. You have to look at the macro. You have to understand, okay, first of all, do I need access? And you might, do I need access to that 100 grand this year? If you do, if you already have something that we just went over that scenario where you're earning 22% rate of return, you need to commit those dollars over there, you may want to look into that.
Right.
But if we can be patient, if we do see that, hey, especially right now, we're in kind of some uncertain times. Yep. I'm getting a lot of people hopping on the train right now because they don't want to put their money into a market currently. There's so much flux going on. They're like, I wouldn't invest right now. I'm not saying they're right or wrong. That's just what their comfort level is and their risk tolerance. And I said, okay, great. This is an ideal opportunity to start funding one of these policies, because when you do hop back in the game, instead of you squeaking by with a 12 or even finding that awesome 20+% rate of return, now, because you were patient over the last 5 to 7 years and you funded this, you're now able to knock that first deal right out of the park, and you're earning 90+% rate of return on the first transaction you go back to market with. So I feel like over time, you actually made a better financial decision being patient and saying, hey, I didn't take a transaction down the past 5 years, but now when I do take this next one down, I can almost make up for that lost time. I get to deal 2, I've more than made up for lost time. I'm talking deal 3, 4, and 5. Man, I truly have 4 to 5x'd what I could have done without taking that strategic saving step.
Right. And I think one of the other things here that's in it, and again, I don't want to get into all the nuances of, these particular, maybe I probably have already done that. All right. So we did get
You're doing great. Yeah, you're good.
Scratch that. One of the things I think that's interesting in these, and I've done a fair amount of reading on these policies and just kind of how these are structured and how, like you're talking about, wealth building strategy is probably some of the estate protection tools and things that are inside of there. So I think as a more comprehensive plan, these could fit in very nicely, especially on that front where it's, it's not subject to creditors and things like that. So you can kind of shovel some money in places that, God forbid somebody comes after you that they can't, that other people, lawsuits, et cetera, just can't access. So I think some of those things are also super powerful. Eddie, this has been very insightful. I've really enjoyed the way you came on the show last time, and we just talked about the comprehensive kind of wealth plan, how to look at the holistic view of building wealth and how the tools and strategies that are available to us. I know we've gone really deep in the weeds here on strategies of how to use the correctly structured cash value whole life policies inside of our real estate transactions and how that can maximize your returns. This has been a blast. Thank you for sharing it. If our listeners do want to get in touch with you and learn more about you, what is the best way to do that?
Yeah, I'd say the simplest way is visiting martinilegacy.com. You can read more about me there, and it's a really simple way to hop on my calendar, schedule a free complimentary consultation that we can kind of go over your wants and needs, see where you're at on your real estate investment and retirement journey, see what we can do to make some tweaks there. And if you're on social media, just look up at Martini Legacy or at Eddie Martini. Be happy to chat with you there.
Eddie, thank you again so much for your time today. I do appreciate it. It was a blast having you on the show a second time.
Thanks for having me, Sam.
Hey, thanks for listening to the How to Scale Commercial Real Estate podcast. If you can do me a favor and subscribe and leave us a review on Apple Podcasts, Spotify, Google Podcasts, whatever platform it is you use to listen, if you can do that for us, that would be a fantastic help to the show. It helps us both attract new listeners as well as rank higher on those directories. So appreciate you listening. Thanks so much and hope to catch you on the next episode.